Now you're. All right, we'll go ahead and get started, and whoever we're missing, they can come in. I'm going to go to PowerPoints here in just a second. We'll get started. Chapter 2 and then chapter 3 are what we're working on today. And chapter 2 deals with the financial market environment. I'm trying to move this over here. There we go. Oh, there's LaTanya. We're missing one more. We'll get going. We'll let LaTanya get on first. Take a second. LaTanya, if you're on, if you'd let me know you're hearing us, and I'll get going. LaTanya, can you hear me? LaTanya, can you hear me?
Hey, I can hear you now.
Okay, and Sheila, can you hear me? Sheila? Oh, she's on there. Sheila Betts, if you can hear me, let me know. Unmute. We can't hear you if you're talking. There she is. Okay, can you hear me? Sheila? Sheila, can you hear me? Sheila? Sheila Betts, can you hear me? Sheila, can you hear me? Sheila, I just sent you a chat. Can you hear me? I don't think she can hear me. Can you hear me, Sheila? Can you say something? Hello? She must have the sound off. Where's a marker? Sheila, can you hear me? Okay. All right, we're gonna give Sheila a second to log off and re-enter. She couldn't hear us. Okay, did anybody have a question before we start real quick? No? Did anybody have problems with the homework? I know I asked some of you that already. If you did, just buzz on in. No one? All right, as soon as Sheila gets back on, we'll start. Make sure she can hear us. Justin, are you at work?
I am. My service is not so great at home, so I decided to stay here so you can see me and hear me a little better.
Waiting for Sheila to get back on. She must have a bad internet connection. I apologize for this. I just don't want to start without her. Shelly, I guess you got your mic on. Shelly, are you guys looking at PowerPoint slides right now?
Yeah, I've got one right here printed out.
But I mean on the screen?
Oh, yes, on the screen. Yes, sir.
Okay. And then just to let everybody know, we're recording. I'm going to try and save it. That way, if anybody wants to go back and relook at it, you can. I don't know if it's going to work. I've never done it before. I've never recorded a Zoom. We're waiting for Sheila still. She must be having internet connection problems. I think I lost somebody. Okay, there should be somebody here. Let's see who that is. Sheila, is that you on the phone?
Yes, sir.
Okay, you won't be able to get the video, will you?
I'm trying to see, can I pull it back up now?
Okay. I just let you in on the, it looks like on your computer.
Okay. I have the video.
Okay. All right. Okay. Oh, Sheila.
Okay, now it's echoing.
Echo. Is it fixed? Sounds like it. Okay. It's so hard to do this. I gotta have somebody on there so I can see their faces, so I can see if you're actually getting it. Okay. Today we're gonna look at chapter 2 and 3, and chapter 2 deals with financial markets, financial market environment. And we'll understand the role that financial institutions play in managerial finance. We'll contrast the functions of financial institutions and the financial market. We'll describe the differences between the capital markets and money markets. We'll explain the root causes and subsequent effects of the 2008 financial crisis and recession. And we're going to understand the major regulation and regulatory bodies that affect financial institutions and markets, and discuss business taxes and their importance in financial decisions. Now, if you are a firm, you can finance your activities 4 different ways. 3 of them are external sources of financing. The first one, which is not on this list, would be you could finance through retained earnings. If you remember from accounting, that's when a firm, say a corporation, earns profits, but it doesn't pay those profits out to shareholders. Instead, they retain those earnings and they can finance out of retained earnings. So if they were going to expand or something, if they had enough in retained earnings in the firm, say to build a new factory, they could just pay it they could finance it internally through retained earnings. Now, there's a cost to that, and that cost is if you finance through retained earnings, then you didn't pay those earnings to shareholders, and they might be upset about it. Okay, I'll tell you this numerous times, but there's only one reason to ever own a share of stock. There's only one reason, and that is because either it is or you believe it will pay dividends in the future. The only money that shareholders get back from a company that they've invested in, a corporation, the only money they ever get back from the corporation is in the form of dividends. Okay? If the company never pays dividends, then there's no reason to own the stock. When you buy the stock, you're buying expected future dividends. You expect to get paid from the company for your investment in the future. Now, that's funding internally. If you're going to fund externally, there's 3 ways. The first one is through a financial institution like a bank. You could get a bank loan. There are also finance companies out there. I had a client once when I worked for the bank. Oh, Titus good. Titus, if you're just getting back on, you haven't missed much. I had a client, and it was a really neat business. He had bought an old Bosch factory from Bosch. I think he used to be the manager of it. And he bought this Bosch factory, and they were making router bits. And he took this factory, and he could mold metal, and they had these big metal-looking things. They looked like big suitcases, and they put this powder in it. And then you could send them anything that you wanted engineered, and they would take things, sometimes that were more than 1 or 2 pieces, and they would create a wax model of it, and they would try and engineer it into one piece. And they did like valves and nuclear valves and things that you couldn't get from manufacturers anymore. So they would mold this thing in wax, and they put it in this powder, and then they would close the suitcase up, and the thing's enclosed in powder, and they would heat it up, and the melt would wax, and the powder would turn into a very hard ceramic, and the wax had channels, so you could pour metal into the mold, and it would fill all the different little parts. And then they would, they did that for companies that needed things made. Well, he had a problem, and that is he had a problem with financing. So he couldn't get a bank loan, and that's what I was trying to help him with. So instead, he was going through a finance company. And they were, in essence, using his credit card machine as collateral. So if his customers paid them with a credit card, instead of the money just going to him, it would go to the finance company first, and they would keep taking the money until they were paid for the month or whatever. And it was a bad deal for him, but that's another example of a financial institution. We'll talk about what it includes, but it's not just a bank. It could be a finance company. There, instead of using depositors' money to make loans like a bank does, a finance company takes investors' funds or maybe bonds. They might sell bonds on the bond market and use that money to lend to their customers. The second way that they could obtain financing external to the firm is through financial markets. That could be through capital markets where you sell bonds. Excuse me, sell equity in the term of shares of stock. You could sell preferred stock. You could sell bonds, or for short-term loans, you could go through money markets. Those are all examples of financial markets, and they're mostly in New York. The third way that you could finance external to the firm is through private placements. Now, we'll talk more about this a little bit later, but when you finance with oh my gosh, that glare is horrible right in my glasses. You guys can see my beautiful eyes. All right. But see, Titus is laughing. You don't think my eyes are beautiful, Titus?
I didn't say a thing.
Do I have beautiful eyes, Titus?
I mean, they're beautiful. The glasses, you make it work.
Thank you, sir. Thank you. Okay. So anyway, you're my favorite student now, Titus. Number one. So when like a large corporation wants to finance themselves, say they want to get, whether it's a startup or whether it's an existing firm that wants to acquire capital to use to invest in, say, a new factory or plant, they'll go through an investment bank. And this investment bank, instead of selling, say, shares of stocks or bonds to brokerages where they go and become publicly traded, instead, they'll sell these newly issued bonds or stock to private sort of investors, other investment banks, or maybe to very wealthy individuals or corporations. And one of the classic examples of this private placement was during the financial crisis. Goldman Sachs. I shouldn't say Goldman Sachs. You always have to say the evil Goldman Sachs. Preface it with evil. They needed money, and they did borrowed I think $2 or $3 billion. I think it was $2 billion from Warren Buffett, and they did it through a private placement. They just created some bonds with special conditions and sold them to Warren Buffett. Okay, so that's an example of a private placement. Now, the first way you can finance externally is through financial institutions, okay? And now financial institutions, I've got the definition up here. These are intermediaries that channel the savings of individuals, businesses, and governments into loans or investments, okay? The typical example of this is your commercial bank, okay? Shelley deposits her savings, and she's got a lot, into the bank, right? And the bank takes those savings, finds a hopefully creditworthy borrower, and they'll lend Shelley's money to that company. Okay. The bank, their role in the market is as an intermediary. Their job is to match up savers like Shelley and borrowers like XYZ Corporation that wants to build a new factory. Okay. The key suppliers and demanders of funds are individuals, businesses, and governments. So this pool of savings is from what we call net savers, okay, or net suppliers of funds, people or institutions that have excess money that they don't want to use at this point in time. And the bank finds a net demander of funds, say a company that's spending more than they have in funds. So they need to borrow the rest, okay? And at either end, although it could be an individual, a business, or a government on both ends of this. So you could have the savings of individuals being lent to a government or to a business or to an individual. You could have the savings of a business being lent to a bank, an individual, or a government, and so forth and so on. Okay. Now, commercial banks are institutions that provide savers with a secure place to invest their funds. That's what the book says. And they offer loans to individual and business borrowers. Okay. So the typical way you can identify a commercial bank is that they have checking accounts. Okay, a checking account. So Wells Fargo, it used to be Compass Bank. Is it BBVA Compass now? Just trying to think of Alabama banks. Okay, those are all examples of commercial banks. They have checking accounts. They offer their customers checking accounts. But they take the funds from their depositors and they offer loans to individuals and business borrowers. Another type of financial institution is an investment bank. And these used to be separate. We'll get to that in a little bit, but kind of been melded together and blurred now. Used to be you could not be a commercial bank and invest in investment bank and involve yourself in investment bank activities and vice versa. They were clearly separated. Now that line is kind of gone. We'll explain why. But investment banks are institutions that assist companies in raising capital. Okay. They advise firms on major transactions such as mergers or financial restructurings, and they engage in trading and market making activities. Examples in the past of investment banks would be Merrill Lynch. Merrill Lynch is now part of Bank of America, but before Bank of America bought them during the financial crisis, Merrill Lynch was solely an investment bank. Another example, Goldman Sachs, which I'm sure everybody has heard of. Rulers of the universe, Goldman Sachs. Morgan Stanley is another example. And I think these guys are still a pure investment bank. Oh, my brain just went on me. They're on every corner. Oh, I'll have to remember the name later. Gosh, my friend used to work for him too, and I can't remember the name of it. But they used to be completely separate from commercial banks. Edward Jones, that's the name I was thinking of. Edward Jones is a commercial bank. Okay. Now, as I said before, they used to be separate. Used to be if you were a commercial bank, you couldn't engage in investment banking activities. but that wasn't always the case, and it is no longer the case now. In 1933, the US Congress passed something called the Glass-Steagall Act. And that act also created the Federal Deposit Insurance Program, and it separated the activities of commercial and investment banks, okay? And the reason that this was done is because there was this belief that the Great Depression was caused by commercial banks using depositor money to engage in risky investment banking activities, okay? And remember, we said that investment banks assist companies in acquiring capital or funding. They advise companies on major acquisitions and mergers or restructuring, and that they advise companies, that they engage in trading and market making activities. So it used to be that banks were doing all this stuff along with being a commercial bank. When the Great Depression happened, all these banks failed. So Glass-Steagall was created because it was believed that a lot of these banks went belly up because they were using investor funds, depositor funds, to engage in investment banking activities. So the two were split. This belief was sort of overturned, or people changed their minds. And the Glass-Steagall Act provision separating commercial and investment banks was eliminated in 1999 by Congress. And I believe that was under Bill Clinton. I'm trying to believe, I think that's true. Okay. So now most of the big banks do both. Wells Fargo has an investment bank, Wells Fargo Securities. Bank of America has an investment bank, Merrill Lynch. Goldman Sachs, which was an investment bank, has now been reclassified as a commercial bank, even though they don't take checking account balances. They don't have checking accounts. Goldman sort of doesn't have to follow the rules for some reason, but they applied and were accepted to become a commercial bank during the financial crisis. And they did this so that they could access the Federal Reserve's discount window. And that is a facility of the Federal Reserve Bank of the United States where they will lend you money short term if you have the proper collateral. And Goldman needed cash and knew they might need cash in the future. So they became a commercial bank so that they could borrow money directly from the Federal Reserve Bank. Another type of institution your book calls the shadow banking system. And this is a part of the banking system, or a part of the financial markets, that has sort of grown lately. And it's really big, especially in China, okay? And this describes a group of institutions that engage in lending activities, much like traditional banks, but they do not accept deposits, okay? A bank accepts deposits, a commercial bank, okay? And because they do not accept deposits, they are not subject to the same regulations as traditional banks, okay? The banking industry, if we talk about commercial banks, are highly regulated. Okay, there are regulators that go through the banks every night, or Trump made sure that they had adequate reserves. And they were required to hold 10% of their deposits on reserve. So a commercial bank has to be able to demonstrate that they hold at least 10%, had to, they don't have to anymore. Demonstrate that they held at least 10% of their deposits on reserve. A institution in the shadow banking system doesn't have to do that. Okay, banks have to demonstrate to the Federal Reserve and regulators that they made loans that were good, that they have this set criteria to lend money to people, and that they follow it. Okay. The shadow banking system institutions don't have to do that. Now, in the US, and this is one of the problems with having an older book, you don't get as much of the current changes that are going on, but it saves you guys money when you have to buy it. This, I think, is what, the 14th edition. This book is at least on the 16th, maybe 17th. But the US banking industry has been going through a long period of consolidation. And that means where there were a lot of banks, there's fewer banks, okay? And this was really big in the 90s and early 2000s, where banks, especially bigger banks, were buying up smaller banks. And smaller banks were being bought out by slightly bigger banks, trying to create bigger banks, okay? And if you look here, these numbers are actually old, but according to the FDIC, the number of commercial banks in the United States declined from 11,463 in 1992. And if you think about that, there's 50 states. So for each state, on average, there were 200 banks in each state. Now that could be anywhere from mom and pop's little bank up to a large national bank like JP Morgan Chase in that state. Okay? And that number would decline almost in half by 2013, so that's in 20 years, to about 6,000 banks. So we went from having about 200 banks per state down to 100. And a lot of those banks were bigger banks, okay, buying smaller banks. And this decline is concentrated among small community banks, which larger institutions had been acquiring at a rapid pace. So we had this consolidation in the banking industry. So we talked about financial institutions. That's one way a firm can get external financing. The second way that a firm can get external financing is through financial markets. And that's what we're going to talk about now. Financial markets are forums in which suppliers of funds and demanders of funds can transact business directly. So they're different from financial institutions where you got the saver, the borrower, and then someone in the middle, the bank. Here, on the financial market, you cut the bank out of it. So borrowers and lenders deal with each other directly. Transactions in these markets that are short-term, what we call short-term marketable securities, take place in the money market, while long-term securities take place in capital markets. Okay. A private placement, which was another way of gaining external financing, involves the sale of a new security that could be a bond or a share of stock to an investor or group of investors. Okay. Like Goldman Sachs wanted to raise money, so they sold bonds directly to Warren Buffett. Okay. They didn't involve themselves with security markets like the money market or the capital market. You end around the market. Most firms, however, raise money through a public offering of securities, which is the sale of either bonds or stocks to the general public. So that's through a financial market. When we talk about these financial markets, we have primary and secondary markets. The primary market is the financial market in which securities are issued or initially issued. This is the only market in which the issuer is directly involved in the transaction. So the issuer might be a corporation, let's say John Deere, and they want to raise money to refit one of their plants to come out with a new tractor model. Okay, so they are the issuer of bonds or stocks. So they would decide how they want to raise this money. Do we want to sell equity in the company in the form of a stock? Or do we want to borrow money and sell a bond on financial markets? Okay, so let's say that they decide to finance this retooling through bond issue. They're going to borrow the money. Okay. They work with an investment bank and they issue bonds. And those bonds are sold on the primary market. And they would be sold to usually stock brokerages, banks, other investment banks, who are then going to sell them to their customers. So, Titus, you're an investor, right? You've got $1 million. You want to invest it, okay? And you're a client of Edward Jones. John Deere wants to borrow money. They're going to work with an investment bank like Goldman Sachs. And they're going to decide we need to borrow $100 million. So we're going to issue $100 million worth of bonds. Edward Jones might buy $2 million of that issue. When Edward Jones buys those bonds, that's on the primary market. And whatever they pay for them, they're going to pay less than $2 million because they're going to sell them for $2 million to Titus and another investor. So they pay John Deere. And that's where John Deere gets their financing. On the secondary market, so then they sell them to Titus. So Titus now owns $1 million of these dollars worth of these bonds. When you buy them, they now get listed on a stock exchange. Okay, so Titus has the bonds. He bought them from his broker, Edward Jones. They're now listed on the bond exchange. I said stock exchange, I meant the bond market. Okay, and let's say Titus wants to sell some of it. He's going to sell those bonds maybe to Cat, right? Cat, do you like Cat or Catherine better?
I go by either.
Okay, so he's going to
Most
sell.
people call me Cat.
He's going to sell $500,000 of that to you. Okay, that would be done on a secondary market because those securities are pre-owned, right? Titus owned them. And now he's selling them to you. That is a secondary market. Now, let's say Titus makes a profit on them. let's say he sells half of those bonds to you. He paid $500,000 for them when they were issued. And let's say you pay $600,000 for those bonds. Okay. That profit doesn't go to John Deere. That's Titus's money. Okay. John Deere, for all intents and purposes, is done with that bond, except for paying it off, making the payments on it. So the companies themselves don't get, the issuer, don't get any money from the sales of securities on secondary markets. They only get their money on the primary market. Another way of looking at this, okay? Shelley, let's say Shelley wants to go buy a house, okay? And it's a $200,000 house. From the looks of it, Shelley lives in one much larger than that. It looks like a mansion from my view.
No.
Shelley's going to buy a house for we'll make it $500,000. Looks more like it. So Shelley doesn't have $500,000 cash. She needs to borrow the money. So Shelley is going to go to her bank. Okay. I don't want to know what bank you actually use. We'll just pick Wells Fargo. So Shelley goes down to Wells Fargo and talks to a mortgage banker, and they agree to lend her the $500,000 she needs for the house. Okay. So they go to the homeowner and they buy the house from him. They give him the money. Shelley now has a mortgage and her name on the deed with Wells Fargo. And that mortgage, right, that Shelley signs, the bank now holds the mortgage, okay, the paperwork. It says that Shelley owes them the money. That is the primary market for mortgages. And that is between the buyer and the bank or mortgage company that they finance the house from. That's the primary market. Now, Wells Fargo has the mortgage, and it's just a piece of paper. And it says that Shelley is going to make monthly payments of $1,200. We said it was $500,000 house of $3,000 a month every month on the 31st for the next 30 years. And then she'll own the house. That's what the mortgage says. Wells Fargo might turn around and sell that mortgage to somebody else. I'm sure you've heard of this. Maybe some of you that own homes, it's happened to you, where you went to a bank or you went to a mortgage banker or a mortgage company and you got a mortgage. And then they sent you a letter in the mail, hey, we sold your mortgage to someone else. Okay. That selling of the mortgage by the issuing bank to someone else, that takes place on a secondary market. Okay. The bank owned the mortgage that Shelley signed. When they interacted, the bank and Shelley, that was primary market. Now the bank owns this mortgage and they turn around and sell it to somebody else. That's done on a secondary market. Now, typically, they don't sell Shelley's individual mortgage. They take a bunch of mortgages and they package them together. And we'll find out in a little bit, that's called securitization. And they'll sell all of these mortgages from Shelley and other people like her on a secondary market to another bank, or more likely to Fannie Mae and Freddie Mac. And those are currently partially owned by the US government. Okay. It started off, and we'll get to this in a little bit, but Fannie Mae, originally it's a Federal National Mortgage Assurance Corporation, or FNA, Federal National Mortgage assurance enterprise. And these originally started off as parts of the government during the New Deal. Okay. And they were created to promote home ownership rather than rental, and to keep home mortgage markets liquid, which means money flowing through them. So that, you know, Shelley bought a house today, maybe Kat decides she wants to go buy a home tomorrow, that there's still money to borrow, okay, when Kat wants to buy a house, all right? And they were parts of the government, and they issued bonds on financial markets. They borrow a bunch of money, and then they would use it to buy mortgages from banks. And when they did that, they created this secondary market for mortgages. And they were the only ones on it for a long time. When Nixon, part of the problem with Fannie Mae was Fannie Mae was such a huge part of the housing market, and they had borrowed so much money that debt that Fannie Mae had was part of the government debt, because they were a part of the government, that in the 70s, interest rates on US government debt went sky high, okay? And the US government was having problems borrowing money to fund their budget deficits. So in the 70s, Richard Tricky Dick Milhouse Nixon decided to spin Fannie Mae off of the government's books, okay? And he created a GSE, Government Service Enterprises. And it is a quasi-private company now. And he created Freddie Mac to compete with it so that there wouldn't be a monopoly buyer on the secondary market. So when he did this, that took Fannie Mae's debt off of the government's books and onto this private company, Fannie Mae, so that the US government looked better when they wanted to go out and borrow money. Okay? But that's the example of primary and secondary markets. This is a nice little graph here. Oops, I went past it. Here you have supplier of fund. These are savers, individuals, businesses, and governments. These are the demanders of funds, individuals, businesses, and governments. In the case of a mortgage, an individual, Shelley, was a demander of funds, right? She wanted to borrow $500,000 to buy her house, okay? In another example, we used ABC, or John Deere, right, was the demander of funds. That's a business. When Titus had $1 million to invest, okay? And the government can be a demander of funds. Now, these lines trace the flow of funds and what comes back to the supplier of funds. So the first thing we looked at were financial institutions like your commercial bank, okay? LaTanya takes a bunch of her money down to Wells Fargo and deposits it in her savings or checking account, okay? Now, the bank issues her a deposit or a share. So she now has a bank balance, right, with the bank. The bank then takes this money and lends it to, say, a local business to open up a new hat store, okay? So the funds go from the financial institution to the local business, they sign loan paperwork that goes back to the bank. So the customer here, LaTanya, is owed money by the bank, not the company that borrowed the money. So even if the loan goes bad and the local company doesn't pay back the bank still has to pay back LaTanya and pay interest on her loan, on her deposits. Okay? Now, these financial institutions, they make their money by matching up borrowers and savers. So they pay LaTanya a pittance on her deposits, say 0.05% on her savings account balance. And then they lend that money out at 4% or 5% to the company, maybe 8%. The bank makes their money on the difference between what they get paid back from the borrowers minus what they pay to their depositors. There's an interest spread there. That's where they make their money. They're getting paid back at 8% on their loans, but they're only paying 0.5% interest to their depositors. Okay? And that's where funding is done through financial institutions. With financial markets, down here, financial markets, we have suppliers of fund. Connie has a lot of money. Connie goes onto financial markets with her stockbroker, and she sends funds to John Deere, and they issue securities that pass through the financial market directly to Connie. So here, if John Deere doesn't pay off on the bonds, Connie loses her money. If the local company doesn't pay off on their loan, the bank loses money, not LaTanya. And then here we have private placement, where the supplier of the funds gives the money directly to the demander and receives securities directly back and doesn't go through a financial market. Everybody understand that? It's a picture version of what I just told you. Connie, you're laughing. Do you understand, or do you just think I'm
I
funny?
understand. My daughter just walked in the room. My
Oh,
husband.
okay.
Come on.
Okay, I thought you were laughing because you didn't understand what I said.
Understand.
All right. Now, when we talk about financial markets, we're talking about those financial markets now, right? There's different kinds. The first one we're going to talk about is the money market. And the money market is created by a financial relationship between the suppliers and demanders of short-term funds. Okay? Short-term funds. These are typically less than, and I want to make sure I get the exact number right here, less than 1 year. Okay, so these are bonds or securities that are typically less than 1 year. Most money market transactions are made in what we call marketable securities, which are short-term instruments, such as U.S. Treasury bills issued by the federal government. Now, when we talk about U.S. Treasury bills or U.S. Treasury debt, we have to be careful. These things get different names depending upon how long they're for. So U.S. Treasury bills are typically less than 1 year, and there are 1 year or less. They're typically 3 month, 1 month, 6 month, 9 month, and 12 month Treasury bills. And that's where the US government borrows money short term. Now, what's about to go on here that ends in April? Anyone know? Latanya, your mic.
Tax season.
Income tax.
Income tax season, right? Also known as large-scale institutionalized systematic theft. Okay. So for the next several months, the government's going to have a lot of money coming in tax revenues, aren't they? Income taxes. Later on in the year, say November, December, they may not have a lot of money coming in. So they may borrow money in November, short term, and then they're going to pay it back off when the tax money starts coming in 3 to 6 months later. So that would be an example of a US Treasury bill. Okay. When we have short-term debt instruments issued by businesses, we call those securities commercial paper. Archer Daniel Midland is an agricultural company, right? In the spring, they have a lot of expenses. They've got to pay for the gas to run the tractors. They've got to pay people to plow and de-rock the fields, to buy seed to plant the corn that they use, that they grow. And they got a lot of expenses. But they don't have any corn to sell, right? That grows and gets harvested in the fall. So Archer Daniel Midland might use commercial paper to borrow the money to pay for maybe the gas and the seed that they use in the spring to plant their crops. And they might borrow that money for 6 months or 9 months, knowing that they're going to have a bunch of cash coming in the fall when they sell those crops to pay them off. Okay. So that's an example of commercial paper. They might issue 6-month or 9-month commercial paper, which is a debt, a bond, in essence. We call it commercial paper, not a bond, to borrow money for 9 months. Businesses typically use commercial paper to even out cash flows, like Archer Daniel Midland, right? They got huge cash flows in the fall. They have low cash flow in the spring when they plant. So they'll use commercial paper to borrow the money in the spring, knowing they can pay it back in the fall when they have all kinds of money. All right. Another example of a security on the money market, a debt instrument, is negotiable certificates of deposit, CDs, issued by financial institutions. Now, there's typically 2 kinds of CDs, 2 main kinds. There are negotiable and non-negotiable. Okay. If Sheila goes down to Wells Fargo with, say, $5,000, let's say she got her tax return for $5,000 and she knows she's going to use that at Christmas time, right? So she says, I'll just save this money till December and then I'll buy Christmas presents with it. Okay. She would go down there and buy a CD. Typically, the CDs that you buy at your local bank are what we call non-negotiable CDs. That means that Sheila has to hold that CD until December and has, in essence, given the bank that money to use until December. It's not her money anymore. The bank will pay her interest on it maybe every month. But if Sheila wants that principal back, the bank doesn't have to give it to her. She signed it away. So if she wants to get that money back, the bank will give it back to her, but they're going to charge her a penalty based on how long she's held the CD for. They might take 1 month or 2 months worth of interest out of the principal and give her less than she gave them. And Sheila can't sell that CD to someone else. Let's say that Sheila bought the CD, thought she could wait till Christmas, but the roof on her house leaks and she needs to pay $5,000 to repair it. Okay. And this is in June. She's got to repair the house in June. She can't wait till December. She can't sell that non-negotiable CD to Tanya, who's willing to wait till December for the money. But if it's a negotiable CD, she can. These are sold on money markets, and they are typically sold by lending institutions that don't have customers coming in the door. I can't remember the name of that bank because they keep changing their name. What's the name of a big online bank you see commercial ads for? Anyone know? They'll bank you, but they don't have offices.
Is it Western Union or something like that?
They have a bank? I'm not sure.
Does Capital One have a bank, a physical bank, or Bank of
Capital
America?
One,
Bank of
yes.
America.
Bank of America does. They just don't have one in Alabama, but Capital One is a perfect example. Capital One has a bank, okay? But they don't have offices anywhere. You could bank with them online. So, and they issue a lot of commercial paper. I mean, of negotiable CDs. They need to raise money to fund, credit card purchases by people. So they will borrow money short term through the sale of negotiable CDs. So instead of going down to our local bank and buying a CD from Wells Fargo, Sheila goes to it doesn't have to be a stockbroker, but an online brokerage or a stockbroker. And she says, I want to invest this $5,000 till December. They might sell her a negotiable CD. One thing that's nice about them is they can be resold. So Sheila borrows the money, then the roof starts to leak and she needs the $5,000 to repair the roof. She could turn around through a money market and sell that CD that matures in December to Veronica for cash and use that to fix her roof. Okay. And that's a negotiable CD. Okay. People oftentimes like those as investments because they are viewed as being safe, because they aren't always, but they can be sold through FDIC insured banks. Okay. All of these money market, these marketable securities in money markets, the T-bills, the commercial paper, and the negotiable CDs are typically considered to be less risky investments than others, okay? Because of their short duration and because they're issued by either the government, right? The US federal government, large corporations like GE, Ford, Chrysler. Well, Chrysler's not a company anymore. My brain's going on me. John Deere, big companies like that have long established track records of paying their bills. And then the negotiable CDs are sold by banks, oftentimes FDIC insured banks. These things, because they're short duration and who sells them, are typically viewed as being less risky investments. Okay. Now, one of the things to take note here is that these things are typically unsecured debt. If the company goes bankrupt, right, or doesn't pay, you have no claim on their assets unless they go through a bankruptcy, which they would. There is an international equivalent of the US money market, and it's called the Euro currency market. And this is really weird. Here in America, if you go get a bank account, you got to show up with dollars, don't you? I can't think of a bank I know of that has euro denominated bank accounts here in the US. I'm sure there are, but they don't. Okay. In other countries, it's not all that uncommon for a company, let's say, to want to have a dollar denominated account in another country. Say Mercedes-Benz, which is in Germany, sells a lot of cars to the US and buys things from the US. They may want to hold excess dollars in a dollar denominated account in Germany. And there is a market for these, and it's called the Euro currency market. And this is a short-term, these are short-term bank deposits denominated in US dollars or other marketable currencies. So maybe Mercedes knows they're not going to need the money for 9 months. They might go to the Euro currency market and lend that money out to someone else who needs it. Maybe an oil company in Europe that needs to buy oil. One of the reasons people hold these Euro currency, one of the reasons why these Euro currency markets exist is that OPEC countries only have one price for their oil, and that is a dollar price. If you want to buy oil from Saudi Arabia, you can only pay for it with US dollars. Okay? So companies and other people like to have dollars on hand in foreign countries to use as oil purchases. If I put my money in a dollar denominated bank deposit, say a CD, right? That bank can lend my money out short term to a company that's going to buy oil overseas from OPEC, from Saudi Arabia. This Euro currency market has grown rapidly, mainly because it is unregulated. It's in Germany, but it's not in German marks. So the German government doesn't care about it so much. Okay? And because it meets the needs of international borrowers and lenders. And if you look at the bottom here, we talked about these Euro deposits. Nearly all of them are time deposits. A time deposit is basically a CD. Okay? So Deutsche Bank sells Mercedes a 9-month CD and takes in dollars, it takes in all these dollars. They could then go out and lend this money out on the Euro currency market to, say, a German oil company that wants to buy oil from Saudi Arabia to refine. Okay? And that would be done through the Euro currency market. There's another name for these, they're called Euro dollars. Okay? You've probably heard at some point in your life the term Euro dollars. Now, those were all short-term markets, financial markets, under a year. Anything that goes beyond a year or involves the sale of stock that is called a capital market. And that is a market that enables suppliers and demanders of long-term funds to make transactions. So these are typically going to be stocks and bonds that are over 1 year long. Those get bought and sold on capital markets. The typical instruments that get sold long-term on capital markets include bonds. Bonds are long-term debt instruments used by businesses and governments to raise large sums of money, generally from a diverse group of lenders. Okay. A drug company might be working on a drug to cure cancer, okay? And it's going to take them years to develop this drug. They might go out and use the bond market to borrow money for, say, 10 years to fund the development of a cancer drug that they've got to develop, test, get approved, and sell. So they would go to a bond market to borrow the money to do that. And they might need to borrow a lot of money, maybe $10 billion to do this. Okay. Well, other than Veronica, I mean, other than LaTanya, who's got $10 billion to lend to one company, right? So they're gonna borrow money from a lot of different people, and that's where they would go to the bond market. Common stock is sold on capital markets. So typically, when you talk about stock, you're talking about common stock. Okay. And these are units of ownership, interest, or equity in a corporation. So if I'm selling common stock in a company, I'm selling you a share of the company. Okay. You now have equity in the company. And then another thing that might be done there is the selling of preferred stock. Preferred stock is what we call mezzanine financing. And it's unique in that it has the features of both a bond and common stock, but not all of them. It's like common stock because you aren't paid interest. Your interest payments aren't made on them. You're paid dividends like common stock. It's not like a bond, because if the company doesn't pay the dividends on preferred shares, typically the owners can't force the company into bankruptcy. The company can suspend the dividend payment like with common stock. Okay, so they pay you an 8% dividend rate is what they say on the preferred stock. Something happens, the company doesn't want to give up the cash, they can suspend the payment on their preferred stock. Yeah, Titus, yeah, doesn't sound good, does it?
No.
Right, but they can't suspend the payment on a bond without the bondholder's permission. Okay, if they suspend the payment on a bond, then the bondholders can force them into bankruptcy and make them pay. A preferred stock is like a bond in that you do not own a share of the company and you do not get to vote for the board of directors. There are exceptions to this. Okay. So it's like a bond. You don't have any say in how the company is run. Okay. with common stock is different from common stock, because with common stock, you get to vote on the board of directors. Okay, but that's preferred stock. We're not going to talk too much about this, but Berkshire Hathaway is a very interesting company. It was originally a furniture company when it was taken over by Warren Buffett. And he had cash in the company, he invested it, and he was very good at it. So now the company isn't, I don't even know if they still make Berkshire Hathaway furniture or not. No one cares. He owns, it's basically almost like a mutual fund to some degree, okay? But he buys and sells a lot of shares in companies. But anyway, it's one of the most famous stocks ever. And since the early 1980s, a Class A share of Berkshire Hathaway common stock has climbed from $285 a share back in the 80s, all the way up to $114 a share when the book was written. It's actually higher than that now. And that would be nice, almost like investing in Bitcoin, huh? If you'd have bought a share of his company back in the 1980s for $285, you'd have $114,000 share right now. And the company's run by these two very old men, and that's Warren Buffett and Charlie Munger. Buffett at the time of the book was 83, Munger was 89. Munger's well into his 90s now, and Buffett's close to it. I think Buffett is 88 or 89 years old now. And he's just been able to make huge returns on his investments. Now, one of the things that Buffett has done is that he never split the shares, okay? Typically, as share prices go up, and they start to get too high, companies will split their stock. They'll say, oh, you own one share of stock and it was worth $1,000. Well, we're going to split the shares. We're going to give you 2 shares for the one that you owned before, and the share would be worth about $500 a piece, right? And that is to make, to lower the share price. The higher the share price, the more people, specifically retail investors, but others, that you prevent from investing in your company. Typically, it costs you money to do it, but you can do it. But typically, Shelley, when she goes to invest her retirement money or her savings, she's not going to put all of her money into one basket. She's going to diversify her investments. So she might have $100,000 to invest or $114,000 to invest, but she's not going to use that, even though it might be the best investment in her mind. She's not going to use that $114,000 to buy one share of Berkshire Hathaway. Because if Berkshire Hathaway goes down or goes bankrupt, Shelley will lose all of her money, won't she? Mm-hmm. So even though she's got $114,000, she could buy a share of Berkshire Hathaway. She's not. She doesn't want to put all of her eggs in one basket, right? If Berkshire Hathaway goes bankrupt, the share prices go down, some or all of Shelley's eggs are going to get broken. She's going to lose money. She'll want to diversify that money and buy a bunch of different stocks. So if some go down, some are going up to make up for it, right? And in general, she'll make hopefully make a positive return on her money, but she certainly won't have to take that risk of one company going bankrupt and wiping her savings out. Now, why do you think when most companies split their shares and definitely don't let them run up to over $114,000 a share in value, why do you think Buffett and Munger didn't split their shares ever? Why do you think they allowed this to happen? Kat, do you know why? Did you read the chapter?
No, sorry, I haven't gotten a chance to yet.
Did you do the homework? Justin, can you answer that question?
No, I'm not sure I remember that one.
Can anyone answer it? Nobody. Go to page 37 of your book. All right. Why? Here's why he did it. Why they don't allow the splits. Warren Buffett has been able to make phenomenal returns on his investors' money. And of course, a lot of that is his own money. Okay. The reason he allows these stock shares to get so high is because he doesn't want idiots telling him how to run his company. The only people who can afford to buy $114 per share stocks are usually high-end money managers, okay? People who manage hundreds of millions, maybe even billions of dollars that know business and aren't going to elect a board of directors that try to tell him stupid things to do. Okay? He doesn't want Shelley, unfortunately, voting or trying to tell him how to run his company, even though it's not his company. There are shareholders that own big stakes in it. Okay? That's why he doesn't do it. Now, the question that the article there, or the section addressed, is, can Warren Buffett be replaced? What do you think? LaTanya, what do you think? Can Warren Buffett
No,
be
no, he's the company. He is the
Yeah. Now,
driving force of the company.
right. Now, if you look here, he says that they say he's the wizard behind this phenomenal growth. But he says, I've taken the easy route, just sitting back and working through great managers who run their own shows. My only task are to cheer them on, sculpt and harden our corporate culture, and make major capital allocation decisions. Now, I think I'm more in agreement with Tanya, all right? And the book doesn't say one way or the other whether or not these guys can be replaced. They can, but how do you know you got the right guy? Okay. So some people might argue, yes, he can. It looks like Got somebody. Oh, Tice is back. Okay.
Well, I guess there's gonna be a sore thumb here. He can be replaced.
But do you think he will?
Paul Bear
I-
Bryant was replaced several times before they got to a Nick Saban.
Absolutely
So
true.
he can be replaced, but how well would that replacement come to fruition for the company? Because
Right.
Alabama went through a bunch of setbacks till they got to Nick Saban.
Right. How
And that
likely?
may
Yeah,
be
go.
outside of somebody's age, but
Yeah. How likely is it that they get someone who can produce the returns that Buffett has, which are phenomenal? I mean, this guy isn't just making high returns, he's making the highest returns almost consistently over 40 years, almost 50 years, 40 years now, close to 40 years. Okay. They say they have already picked a replacement for him, but they're not telling anyone who it is. Okay. The board has decided, is solidly in agreement as to whom the next chief executive should be, but they don't mention the name of this person. Okay. So I don't think there's a set answer. We'd have to wait and see. Is it possible? Yes. Is it likely? I would say no. I would say that if Buffett retires or dies, he and Munger leave, that it's very unlikely that they get a replacement who can match what he's done. Now, could he do a good job? Yeah. Could he stink the place up and go bankrupt? Yes. There's all those are possible. Okay. That's the answer. Are you guys ready for a break now? If you do not want a break, speak up. Otherwise, we'll take a 15-minute break. Any objections? None? Okay, thank you. We'll take, what time is it now? Hold on. We'll make it 18 minutes. We'll come back at 7:20. Okay? Everybody be back at 7:20, please.